Let me ask you something real quick. How much of your retirement money are you actually keeping? Because most of the seniors I talk to, people who save for 30, 40 years, are handing a massive chunk of it right back to the IRS every single year in retirement. And the frustrating part, they don't have to. My name is Eduardo, and today I'm going to walk you through 3 accounts that let your money grow and come out completely tax-free. Not tax-deferred, not we'll deal with it later. Tax-free, permanently. And before I go any further, I'm not a lawyer. I'm not a CPA. I'm not giving you legal or tax advice. What I'm giving you is financial education so you can have a smarter conversation with your own tax professional. Always work with a qualified CPA or advisor before making any moves. Got it? Good. Let's get into it. Here's what's happening to a lot of retirees right now. You spent decades putting money into a traditional 401k or IRA. Your employer matched it. Your financial advisor said it was the smart move. And honestly, it wasn't wrong advice at the time. But here's what nobody fully explained. Every single dollar you pull out of that traditional 401k or IRA in retirement is counted as ordinary income. The IRS treats it exactly like a paycheck. So if you're pulling $45,000 a year to live on, the IRS sees $45,000 of income, and they want their cut. Now add Social Security on top of that. Add a small pension maybe. Suddenly your income is higher than you expected in retirement, and you're paying taxes you genuinely didn't plan for. That's the trap. And most people don't see it until they're already in it. The good news? There are 3 specific accounts in the U.S. tax code, accounts that have been there for years, where the IRS simply cannot touch your money. Not on the growth. Not when you take it out. Not ever. Let me walk you through all 3. The first one is the Roth IRA. Now, I know some of you have heard of this, but stay with me. Because most people only understand about half of what a Roth IRA actually does for you. And the other half is where the real money is. Here's the basic idea. A traditional IRA or 401k lets you put money in before taxes, it grows, and then you pay taxes when you take it out. The Roth IRA flips that completely. You put money in after taxes, meaning you've already paid the IRS on it. It grows. And then when you take it out in retirement, you pay nothing. 0. The growth, the withdrawals, all of it, completely tax-free. So if you put in $7,000 this year and it grows to $60,000 over 20 years, you pull out that $60,000 and the IRS gets none of it. For 2026, the contribution limit is $7,000 per year. If you're 50 or older, it bumps up to $8,000. That's the catch-up contribution, and it's there specifically for people who are getting a later start, which is a lot of the folks I talk to. Now here's the part most people miss completely. When you pull money from a traditional IRA in retirement, that withdrawal counts as income. And when your income goes up, 2 things happen that most retirees don't see coming. First, your Social Security can get taxed. A lot of people don't realize this, but up to 85% of your Social Security benefit can become taxable if your income crosses certain thresholds. For a single person, that starts around $34,000. For a married couple, around $44,000. Every dollar you pull from a traditional IRA pushes you closer to that line. Roth IRA withdrawals? They don't count toward that calculation at all. The IRS doesn't see them. Second, your Medicare premiums can go up. Medicare looks at your income from 2 years ago to decide what you pay for Part B and Part D. If your income is too high, you get hit with something called IRMAA, extra monthly charges on top of your regular premium. In 2026, that kicks in around $109,000 for a single person. Pulling from a Roth instead of a traditional IRA keeps that income off the books entirely. So the Roth isn't just about tax-free growth. It's about protecting your Social Security and keeping your Medicare costs down. That's real money every single month. One more thing. If your income is above the limit to contribute directly to a Roth IRA, there's a legal workaround called the Backdoor Roth. You contribute to a traditional IRA first, then convert it to a Roth. It's been allowed by the IRS since 2010. Talk to your CPA about whether that makes sense for your situation. Account number 2 is the Health Savings Account, the HSA. And I'll be honest with you, this is the most underused account I see seniors overlook. Most people think of it as a little fun to pay for doctor visits. That's not what this is, not even close. The HSA is the only account in the entire U.S. tax code with 3 layers of tax protection at the same time. Layer 1, the money goes in tax-free. If it comes out of your paycheck, it avoids federal income tax, state income tax in most states, and even Social Security and Medicare payroll taxes. That's a 20 to 40% savings right off the top depending on your bracket. Layer 2. The money grows tax-free. If you invest it, and you should, it compounds every year without the IRS taking a percentage of your gains. Layer 3. The money comes out tax-free when you use it for qualified medical expenses. No other account does all 3 at once. A 401k gives you layers 1 and 2 but taxes you on the way out. A Roth gives you layers 2 and 3 but not layer 1. The HSA is the only one that does all 3 simultaneously. Now, to contribute to an HSA, you have to be enrolled in what's called a high-deductible health plan. In 2026, that means a plan with at least a $1,650 deductible for individuals or $3,300 for families. If your current plan doesn't qualify, you can't contribute that year, so check with your insurance provider first. The 2026 limits are $4,400 for individual coverage and $8,750 for family coverage. If you're 55 or older, you can add another $1,000 on top of that. Here's the strategy that changes everything. Instead of using your HSA like a checking account for medical bills, invest the balance and pay your current medical costs out of pocket if you're able to. Keep every single receipt digitally in a folder wherever works for you. Because here's the thing, the IRS has no time limit on when you can reimburse yourself from an HSA. You can pay a $300 doctor bill today, keep the receipt, and pull that $300 out of your HSA completely tax-free 10 years from now. That means you're quietly building a tax-free cash reserve over decades, and by the time you retire, you've got years of receipts you can use to pull money out without the IRS seeing a single dollar of it as income. And after age 65, the HSA gets even more flexible. You can withdraw money for any reason, not just medical. Non-medical withdrawals after 65 are taxed like a traditional IRA, but there's no penalty. So worst case, it works like a regular retirement account. Best case, every dollar goes toward medical expenses completely tax-free. Think about this number. The average retired couple is projected to spend over $300,000 on health care in retirement. Every dollar of that coming from an HSA, zero income tax. Every dollar coming from a traditional IRA, taxed at your ordinary rate. That difference is enormous. All right. Account number 3. This is the one I saved for last because it's the one almost nobody knows about. And for a lot of retirees, it's the biggest opportunity sitting right in front of them. It's called the 0% long-term capital gains bracket. Here's how it works. When you sell an investment you've held for more than 1 year, a stock, a mutual fund, an ETF, the profit is called a long-term capital gain. Most people know the government taxes those gains at 15%. What most people don't know is that there's a rate below that, 0%. If your total taxable income after your standard deduction stays below $49,450 as a single person or $98,900 as a married couple filing jointly, your long-term capital gains are taxed at 0%, not deferred, not reduced, 0. Now here's why this is such a big deal specifically for retirees. Think about who tends to have lower income but appreciated investments sitting in a brokerage account. Retirees, especially in those early retirement years, after you've stopped working but before Social Security and required minimum distributions kick in and fill up your income. In those years, you may have more room under that ceiling than you realize. Let me give you a simple example. Say you're a married couple, both retired, living on $38,000 a year from a small pension and some dividends. After your standard deduction, your taxable income is well under that $98,900 ceiling. You've got room. So you sell some appreciated stock that's been sitting in your brokerage account for years with a $50,000 gain built up in it. Because that gain still lands under the ceiling, you owe the IRS $0 in federal tax on that $50,000 profit. That's real money, tax-free. Because you understood where the line was. And here's the move that turns this into a repeatable strategy. After you sell and capture that gain at 0%, you can buy the same investment right back the next day. There's a rule called the wash sale rule that makes you wait 30 days. But that rule only applies to losses, not gains. So you sell, take the gain tax-free, and immediately buy back in. This resets your cost basis to the higher price, which means future gains start from a higher number. You've permanently erased years of built-up taxable gain without paying a dime. This is called tax gain harvesting. A few things to keep in mind. And I want to be straight with you here because this is where people make mistakes. The gain stacks on top of your other income. So you need to know how much room you actually have under that ceiling before you sell. If Social Security and pension income already push you close to the line, you have less room than you think. Also, realizing a big gain in 1 year can push your income up, which could make more of your Social Security taxable or trigger a Medicare premium surcharge 2 years later. So don't just sell everything at once without running the numbers first, or having your CPA run them for you. And this is the federal rate. Your state may still tax the gain. If you're in Florida, Texas, or another state with no income tax, you're in great shape. If you're in a high-tax state, factor that in. So let's bring it all together. 3 accounts. 3 ways the IRS is legally allowed to tax your money and doesn't. The Roth IRA removes your investment growth from the IRS permanently, protects your Social Security from higher taxation, and keeps your Medicare premiums from going up. The HSA is the only triple tax advantaged account in the U.S. tax code. Used correctly as an investment vehicle, not just a medical spending account, it builds a 6-figure tax-free reserve for the biggest expense most retirees face. And the 0% capital gains bracket lets you sell appreciated investments and pay 0 federal tax on the gains in any year your income stays under the ceiling. Time it right, reset your basis, and you can pull tens of thousands of dollars out completely tax-free over the course of your retirement. None of these are tricks. None of them are loopholes. They're written directly into the U.S. tax code and have been there for years. The only difference between the retirees who use them and the ones who don't is knowing they exist. Now go talk to your CPA or a fee-only financial advisor about which of these makes sense for your specific situation. Show them this video if you have to. because one conversation about these three accounts before you need the money is worth more than any strategy you try to put in place after it's already gone. If this helped you, share it with someone you know who's still putting everything into a traditional 401k thinking that's their only option. And subscribe, because I cover these strategies regularly and the numbers change every year. You want to know before the limits shift, not after. I'll see you in the next one.